So let me summarize Hugh's question. Basically, he's investing his own pension. He's finding it a bit daunting to decide which of this 30 or so stocks he says he wants to invest in and how much to put in each one. So basically, like this is, how do I start out as a long term investor? That's kind of his question.
Good question. It's the perennial question we always go back to. First of all, thanks Hugh for joining us. It's a jolly crew. The first thing that jumps out at me, and there's so many things we need to cover, but the first fundamental point is it seems to me you want to just op- you want to sleep at night. It's the sleep well at night quality, especially when you're a beginner, because it can get and it will get scary. I would say psychologically, uh, allocate some amount of money into a investing portfolio that should that go to zero, theoretically, you wouldn't like it, you wouldn't be happy, but you're not going to be out on the street, Hugh. It's a psychological. It's like the first steps where you wanna the trades you make, like in poker. Um, Good poker players, the aggressive ones, the ones that you're up against a real player, they are willing to risk their whole stack when it kind of becomes necessary because they know they're not playing from anxiety. They're not going to be bullied. And I think that's a kind of important first step. Don't bet at all, right? Go slow. How much are you willing to risk and you be okay with losing, and start there?
Yeah, and you're leaning there on like two of our 10 laws of the jungle, um, like know your investment comfort zone and protect your essentials. And you're right. Like if you're, I think Hugh's question is actually, it's got an interesting nuance because if I read between the lines on Hugh's question, he's actually investing his pension. So like in the UK, you might have, say, a workplace pension. I used to have one with my employer, HSBC, and they kind of manage it on my behalf. And I had some really limited choices as to what I could put that in. And then when I left the bank, when I quit, I was able to withdraw that, put it into what in the UK a SIP, self-invested personal pension, and I just manage it like another brokerage account. So it's like one of many accounts I now manage, and I have individual stocks in it. So I think probably Hugh is, I would guess, doing something somewhat similar. And if you're a newer investor, like newer to picking stocks, you probably don't want to like dive in with if it's like your pension. That's probably important money, and it's a lot of money. Um, and so you probably don't want to dive in and like throw that into, like wild companies that you just, and you haven't really learned your investing lessons yet. So with someone like Hugh in this situation, if he's new to analyzing companies and he's new to building like the emotional resilience and the skill set, he probably wants to keep, if he's self-managing his pension now, he probably still wants to keep the large majority of it in similar things that he used to own, like, big passive index trackers like VOO, and so VOO and VW, RL, like some big, track the S&P, track like the FTSE, track the all world, have the majority of your money in those, and maybe have an allocation, which is like essentially, if you're really new at this, it's like your kind of practice money. I'm going to learn some real lessons. I'm going to have some real skin in the game. Let's say you've got, I don't know, like a $500,000 portfolio here. If it's your pension, it might be like big numbers. Well, maybe 400,000 of that is in like this, not so much safe stuff, but it's in like market tracking, easy, like stuff that, like the kind of things that the pension's probably always been in. And maybe you got some bonds and some fixed income, like for like, we're not financial advisors, like do your own due diligence, do like standard stuff. But maybe you take an allocation of that 50 grand, 100 grand, whatever it is, like a percentage, and that's kind of your learning money where you're then going to pick a bunch of stocks. I don't know about 30, we'll come on to that in a sec, but pick like a number of companies, and we'll talk in a minute about how you pick those companies and put, say you had 15 companies and you had $150,000, we'll put $10,000 in each of those 15. And then you're going to start learning some lessons like right away because some will go up and some will go down, and you'll feel some exuberance and you'll feel some pain, and then you start improving your process over a course of years. And as you become more confident, maybe you start to move some more of that like passive money into your actively managed personal money.
All right, Badge, some more nuance there. I want to introduce the concept of, cash as a position.
Mm.
So I would add, Hugh, uh, I'm going to give a real number. It's easier for me to talk about. Let's imagine $10,000 is your, call it year one. I'm in year one. I'm learning how to do this, and I'm going to use $10,000 with which to learn. Very
Yeah.
similar to what we did with King of the Jungle, right? Except we started with 1,000, right? But now you have $10,000, right? So, as Badger said, you got your index funds, you're familiar with those, not much thinking involved there. But let's say you take 25% of the 10,000, so $2,500, and you put that in cash,
Yeah.
right? Now you think of cash, hopefully it's also gaining some interest if you pick the right broker. So that cash is actually also making you some money or at least keeping up with inflation. And now, before you go ahead and buy any companies, uh, since you listen to our show, I would encourage you to look at Monkey's portfolio, look at Badger's portfolio. Maybe start with the top allocation because obviously that's where we have most conviction, right? And then before you buy anything, you do your homework and you spend like, I don't know, I hope it's not overwhelming, but you spend 4 years studying EOS and you spend, I'm sorry, 4 hours studying EOS. I spent 4 years studying EOS. You, Hugh, don't need to spend 4 years. Spend 4 hours studying EOS. Spend 4 hours studying Rocket Lab. Learn how to do that. Right? There's lots of questions about how you do that, but go to their investment presentations and dig around. Right? And then, if you like the story, right, and you feel you could explain it to somebody, then out of the $2,500, I would recommend you make something like a quarter size purchase. That's your foot in the door. So I don't know, that might be whatever, 10 shares of EOS, 10 shares of Rocket Lab, and then you're in, right? You're already in. If that all blows up, you've lost basically nothing, but you've taken the most important first step.
And let me, like, that was all good. I totally support all of that. I want to point at one or two extra things that are really important. Like, you can go and listen to other podcasts and read other analysts and look at like the Motley Fool and Seven Investing and services like this. But the most value you will get is from going to primary sources. It's easy to do these days. Go to, like, just literally Google, say it's Rocket Lab, like you picked that one, or EOS. Just literally Google Rocket Lab IR, like investor relations. Top of the fold, like first couple of results, you will see Rocket Lab's own website, their own investor relations page. Virtually every company, I've never found one that doesn't have like this stuff nice and easily laid out, easy to access. If you're really getting into it, download like the actual financial reports. But if you want to keep it real simple, they'll probably have like a 20, 10, 20, 30 page like PowerPoint, like PDF deck. Just read the deck. Like bear in mind, you're reading like their own, it's got to be factual because there's various laws around, regulatory laws around what they can say. But you're reading like their optimistic take. So, have that filter in your head, but understand the company that way. You'll see probably a bunch of pretty pictures that will really give you a good essence of who they are and what they do. And then, when you want to get a bit more advanced, listen to the earnings call. If you go to an app, Quarter, Quartr, it's fantastic. It's free. They've got like the audio of the earnings call. I'd recommend like listen to it because you get some human nuance from just hearing the voices. Try and understand the analyst questions and why they ask that question. Even if even if the company gives a flim flam answer, there's often a reason why the analyst was asking that particular like line of probing questions that might give you like a hook to do some of more of your own research on. And then if you want to get more advanced still, start looking at really at the financials, by which I mean, not just like the Yahoo Finance page. Go and look at the income statement, the balance sheet, the cash flow statement. If you go to a tool like Fiscal, no, sorry, yeah, no, they are Fiscal.ai. They used to be FinChat. Go to Fiscal.ai. Like the free tier is very, very good. And if you're looking at like a small number of companies, you've got some great data there. Go check out Fiscal.ai, sign up. Or if you sign up at Fiscal.ai/wildlife, you'll get like a handsome discount. But the free tier is good enough to do this like initial research. They've got all of the financial statements there. They've got a ton of other data there, and just start understanding what some of those numbers mean. And if you've got one you don't understand, like ping us on the YouTubes or ping us on the Patreons, and we'll try and help you figure it out.
Yes. Badger, hearing you explain that and trying to put myself in the position of a beginner, which is kind of hard for us, but I think there's a one major I could see a ditch, a pitfall, where to us it sounds like no problem. Okay, I look at the investor deck and I look at financials, and we've been doing this so long, it's like nothing scary. But to a beginner, it could begin to feel overwhelming, especially the financial statements, because all companies, it looks different and they manipulate things, gap, non-gap. Like there's a bunch of stuff. I could be like, okay, fuck this. Like, I'm way over my head. I think before you get there, Hugh
Yeah,
and everybody else in the beginner path, start more Peter Lynchian style and start by doing what I said earlier. Uh, Look at our King of the Jungle portfolios, because we've curated what we think are the best companies, that we know of, and we do this a lot. I'm not saying that's the only companies, but between Badger and Monkey, you have very different kinds of companies. And then do your call it. Let's make it simple. Do 1 hour of research per company, right? And now to not make you feel overwhelmed, do this for only 10, right? So let's say, to make it easy, pick 5 monkey companies and pick 5 badger companies. So now you have 10 companies, right? Here's the important point. As you do this research and you begin to understand, start your own spreadsheet maybe and just rank them in terms of what you think, just completely like holistically, which company did you really enjoy learning about? Have that rank. Make it be clear. Let's say it's Rocket Lab. You're like, man, I love rockets. Cool. EOS batteries. Who gives a fuck about batteries? Like, no, like right. But you'll have a good sense of pecking order. That might be enough to then allocate appropriately, as long as it's not a lot of money, based on the initial understanding. Then, as time goes on, and earnings calls coming out and more info, then you could start making adjustments. But that's a fantastic place to start, I think. And one more point, Badge, and I'll let you take over on this. I do think, because of information overload, it is very easy to pick too many companies and too much information, and before you know it, you've just made another index for yourself.
yeah,
This step is intended to really get you selecting. I call it 10 because that's a nice round number, and at the beginning that's plenty to keep you busy.
yeah, I agree. Like 30 is probably too many, even in a mature portfolio. 10 is maybe a bit low end. Like some people have concentrated portfolios of like 4 or 5 stocks. That's outside my comfort zone. Um, I think generally accepted wisdom is if you have, say, 12 to 15 stocks, and if they're broadly diversified, then you've neutralized a lot of that like exposure risk. Like you have enough diversification, and every additional stock probably doesn't materially improve your diversification. Obviously, if you own like 15 companies and they all do exactly the same thing, you've got no diversification at all. But I love that way in, actually. Maybe we've never said that so clearly. So kudos to you, Christoph. Like literally an hour times 10 companies and pick like the handful, the 3 or the 4 that you just like the story of the most. Like actually enjoying researching a company is really beneficial. It might sound dumb, like who cares? Like, who cares if I enjoy this or not? Is it a good business? But if you enjoy reading about the company, you're going to probably enjoy doing like more deeper research in the future. So you're going to learn more about that company. And if you become like a bit more of an investing geek, the algorithms, the YouTubes will start pushing more content to you because you're just naturally reading about that stuff. And if you're out, say a company operates in like an area where you have either like expertise or a hobby or experience, where it's just like a thing you're passionate about, like I know, freaking like sailing or something, and maybe you found like some brand that makes yachts or produces like clothing or does like ocean mapping or something, right? It's an industry then you'll be reading about because of your hobby around sailing, and you might see this company's name pop up for good or for bad just in the course of like living your normal day. So you're getting like free due diligence because it happened to be something you liked.
You know what? As you were saying that, I could hear some called professional level investors being like, "Ah, these guys are just, like just buy because you like the story. Like that's some amateur shit."
Right.
I think that's a mistake.
Yeah.
I mean, if you're a professional, obviously, but you're working for
You're right. There's a nuance here. Go on.
right,
Yeah.
yeah, you're working for a bank. It's your job to understand every tiny detail on every statement. But I have to reiterate that all the best investments in my career, had I not sold them, all were born because I loved and cared about the company on the story level. I know this is I've beat this horse to death, but if we're talking about Apple and Netflix and Tesla and Nvidia, and like these are Chipotle. It's weird, right? But all I had to do was like the story, continue to make sure it's playing out the way I thought, and had I not sold because I got too smart for my own britches, then I would have way more money than I do now. So it does not actually have to be more complicated if you're a long-term investor. That's the weird thing about this.
Yeah.
I'm not saying that's the only way, but that really is sometimes enough. And then you add the nuances and a lot of other stuff.
And the like you cherry picked your winners there, but let's use an example of a loser, and I'll give one of mine to explain like why this works. Like what we're describing is just literally how you get started if you've got you don't know how to value a company and you're not looking at like primary sources, you're just kind of buying what the latest stock recommendation service told you to buy. Like buy the stuff you like, because then you'll enjoy studying those companies. And let's say eventually over the course of, maybe you do like 10 times 1 hour today, and then next month you do like another 10 stocks, another 10 hours. At some point you've got like 15 or 20 or maybe 30 stocks in your portfolio. You have to keep studying those companies, and if the ones you enjoy are the ones you're gonna, it won't feel like work, it will feel like interesting to study those companies. And you'll watch them over the course of a couple of quarters, and some will perform well and some won't. But you will start asking the right questions that make you a better investor. You'll be like, oh, why is this stock down? And you've got like a rabbit hole to go down. And that's where you start. Then you've got like an entry point to doing like the real job as an investor, actually studying companies. But you've given yourself like an easy way to get going.
Yeah.
If I lean on one of my losers in the past, like going into the pandemic, was it pandemic? No, it wasn't pandemic related. Beyond Meat, like I really like Beyond Meat as a brand. I'm like, it's like these are tasty burgers. I bought stock in the company, um, and then because I enjoyed researching the company, because I'm like it's helping the planet and it's mitigating like animal slaughter and all these horrible things. Um, like I like this investment, and then because I was researching it, I started to notice, oh, like hell, like in the grocery store, like Beyond Meat is here, but they've got like 50 competitors all selling the same product. Like this plant-based like aisle is getting bigger and bigger in my local grocery store. So I started asking like the sensible question, like, is their product really differentiated? And then I ate like, burgers from other manufacturers. I'm like, these are really the same thing. I literally did like a blind tasting with like three different kinds of burger, and I could pick out the Beyond Meat one because I knew it. But I'm like, it's better, but this is like a matter of taste. It's not that much better. So I got out of my position, and like now Beyond Meat, I think they've actually just become insolvent. Like they went bankrupt. Like they've been in big trouble for like a year, well over a year. So, that hopefully by giving an example of like a loser, it's the value is in doing the ongoing work.
Yeah, absolutely. Lululemon comes to mind actually in this kind of topic because that in to your point about cherry picking, I could see somebody loving Lululemon, but if you invested at the top, you're quite underwater now. But from an investing standpoint, forces you to ask the right questions. So it's not that it's so easy and you'll only have winners, but there's lots of examples where I think this is the correct entry for most beginners, and over the long term you're likely to make a lot of money regardless of your financial statement literacy or not. But
Yeah. But those skills will come in time as you study companies. Each time you look at it, you'll learn a little bit more. You'll figure out the stuff like I don't really understand what this number means or this company's saying, and that's like a hook to do more research and improve your not just your understanding of that company, but your skill set as an investor, which will then benefit you when you look at every company.